Dr. Econ here with another explanation as to what's really going on in the marketplace. What I want to do today is I want to go over the housing crisis in 2008 and how it relates today. I hope everyone knows who Warren Buffett is. He's probably the premier investor in the world. Many people go to him for investing advice. Well, he came out in 2003. Now, note, we're talking 5 years before the actual recession started in 2008. So 5 years before that recession started, he said that mortgage-backed securities were financial weapons of mass destruction.
The usage of them on an expanding basis, more and more imaginative ways of using them, introduces essentially more and more leverage into the system.
And the challenge is that mortgages were being written, and all of a sudden the mortgage people, because of an act that Lyndon Baines Johnson signed back in the 1960s that permitted the financial markets to actually take and securitize mortgages, meaning that mortgage companies could go write a mortgage, sell them to a bank, the bank could compile a bunch of mortgages together and then sell them as a package to a bigger bank, who would then take several of these packages and make bigger packages and sell them on to other banks. Well, most of the time what was happening is these were ending up in pension funds, retirement accounts, and all different places that invested in real estate-backed securities. But little was known about the actual mortgages that had become bundled in those securities so deep that they couldn't really tell who the individuals were. These mortgage-backed securities really didn't have any real connection to the person who was actually paying the monthly payment on those bills. In their thirst for writing more and more mortgages, they wrote more and more what they called non-standard mortgages. Those people who could not qualify for the higher tier of mortgage got what they called non-standard mortgages, and a lot of these were either interest-only mortgage where you basically only paid the interest for the first 5 years or so, and then you started paying interest and principal at the current interest rate. That would allow them to get into the mortgage, to get into their house and get qualified at that level. But the problem is many of these mortgages, the mortgage brokers knew full well that if they tried to qualify them for what the mortgage would be in 5 years, that they would never have qualified. Some of these were also adjustable rate mortgages. They weren't interest only, but they started with a very low tickler interest rate to get them qualified and get them into the mortgage. And then 5 or 7 years later, these mortgages would then reset to the main interest rate where they would stay for the rest of the 30 years. So both of these were disasters waiting to happen for many people, because there were a lot of people who suddenly could qualify for a mortgage when they didn't have a prayer of qualifying for a mortgage if it was all left alone and left standard. So here we get this period of time from 2004 to 2006 where the Federal Reserve is raising interest rates. Let me show you what happens. I'm going to refer to a few Excel charts that I put together here. So this is what was happening to the price of houses running up to the mortgage crisis. Now, I started clear back here in 2001. Remember, the Berkshire Hathaway quote from Warren Buffett said that they were starting to issue weapons of mass destruction right in here. So you see what's happening in 2003. All of a sudden, the rate at which houses started increasing price rose dramatically. As you can see, the slope here is going very strongly up. So between this period of time where houses were running at about 175,000 or so right through here, suddenly we're able to rise. By 2006, they had risen up here in the 250 range. This is what the Federal Reserve was doing, okay? So the Federal Reserve, just in this 2001 period, started lowering interest rates. And they lowered interest rates to the point where they got it down to about the 1% mark here in 2003 to 2004. But they saw that these lowered interest rates, along with all these non-standard mortgages being offered, was starting to create a housing bubble. This housing bubble, the rapid increase of prices, they started counteracting, like I said, in June of 2004 is actually when that started happening, all the way up to June of 2006. Now, during this period of time, of course, they're chasing the prices up, and finally the prices start tipping over. And they start saying, well, they finally weeded out the buyers that were getting all these non-standard mortgages. But another thing was happening too. These people who bought back in 2002, 2003, when this whole thing started, these people were now having their ARMs, their adjustable rate mortgages, and their interest-only mortgages starting to reset. And the reset of all those, and the fact that now, since the Federal Reserve rate was so high, and subsequently, if I throw in the next one, which shows the interest rate at the time, the interest rate was starting to rise as well. These people that were caught during this period of time couldn't refinance, couldn't pay their current mortgage, and were forced into foreclosure. Okay, so what happens when there's a whole ton of houses going into foreclosure? What you have is prices that begin to tumble. And so you see this green line going down, down, down. Went from a high of just over 250, about 255, clear down to this number down here in the 208 area. So 255 down to 208. So this is what they call the mortgage crisis. This period in time right here from 2008 to 2010 was a period of recession. It was a period where people lost jobs by the scores. Tons of people were out of a house. The rental market went crazy trying to house people. Housing permits for the first time ever began to fall. In other words, new houses were not being built at the same rate that they were previous, and they started pulling back. So, and then eventually the International Monetary Fund begins warning central banks of various countries, hey, look out for these mortgage-backed securities. Find out how many of those that you have. You've got to reevaluate the value of your collateral, because all of a sudden these mortgage-backed securities, instead of being worth $100, were now worth $50, because they had to track down how many of the people were in default that should have been paying back the money from these mortgages. So many of them were not paying back into it. These mortgage-backed securities deflated to the point where banks couldn't even loan people money because they didn't have enough reserves. By law, they have to have a certain percentage of reserves in cash, both liquid and illiquid cash, in order to then loan out more money to people. If those reserves go down, they can't loan to people, and that's what caused the lockup and the loss of Lehman Brothers when it went out of business, and the mass consolidation of many, many banks at the time. Okay, so you've had a history lesson. Now let's take a quick peek at what is happening today. So remember this chart, this orange especially. Now we see today this run-up of prices here seems fairly normal, okay? The price is running from a little less than 300,000 and they're up at about 350. Then along comes COVID. So we see 2020 coming along here, and then what happens? All of a sudden, house prices just take off. We've got situations in various places where people were making as many as 30 or 40 different offers on houses and having them turned down until they finally got somebody to accept the offer that they made on their house. The problem with that was that people were chasing bids. people would list the house and they'd chase that bid higher, higher, higher until some people were paying as much as 60 or 70,000 more than the actual asking price of the house. That is the craziness that was going on here. So we see here where this bottom here was at 322, the topping out here currently is at 459, 132,000 difference from 2020 till now, the end of 2022. Now, that I guarantee you is a bubble. Our current Fed Chairman, Jerome Powell, stated that they were unhinged from fundamentals. Now, what does that mean? Well, unhinged from fundamentals basically means that you and I can't really afford to keep paying more and more and more for a house when our income isn't going up, when our mortgages are not going to be able to support and sustain the amount of money that we have to put out every month. In other words, they're becoming unaffordable. Unhinged from fundamentals means that a certain number of people are just not able to buy houses anymore. So it's going up. Now let's put the next piece of data in there, and we can see now, here's what actual mortgage interest rates have done. Now, part of the challenge was that the Federal Reserve was lowering interest rates all the way through this period of time. And then all of a sudden here, the interest rates were incredibly low, down in the 3% range. Now, historically, that's pretty doggone low. In fact, in 2015, it's pretty low. Mortgage rates really have historically been in the 7 to 8 range for mortgages, not clear down here. So you can see that this inflation was probably warranted just by the fact that money was fairly easy during that time. And then it just kept getting easier and easier as the Federal Reserve kept on making money more and more easy to obtain. Well, when you have easy money to obtain, that means I can afford more. If I'm paying interest down here, I can afford a bigger mortgage. And when I can afford a bigger mortgage, I can keep bidding the price of houses up. And it also psychologically affects the sellers in the respect that the sellers can then ask more for their house, knowing that people can stretch more to buy a house. I don't have to sell my house at 300 if I can sell it for 350, because I know there's somebody out there that'll rather have my house, and though they're willing to pay 350, and I'll just wait until that buyer comes along. So you have this psychology driving the prices of houses upward. Now, as they continue to drive upward, what's the Federal Reserve doing? Well, Jerome Powell comes out and says that the housing prices are unhinged from reality. So now what? So they come over here a little bit too late. Look at this, how long this has risen before the Federal Reserve takes action. Now, understand also during this 2020 to 2022 timeframe, the Congress is also pumping money into the economy. Now, those of us who were lucky enough to have jobs all the way through COVID, what did we do with the money? Well, we just either paid off our credit cards or put it in the bank or bought bigger houses. Okay? Those that really needed the money, of course, kept food on the table, and we're grateful for that. But the bottom line is that there were a lot of people who didn't need the money but could use the money, and they packed on more investments. And a logical investment with this kind of raise in prices was the housing market. So we saw a lot of investment people continuing to drive the prices up. So the Federal Reserve starts to react here. So we're talking January of 2022. They finally start to react. Good heavens, the houses have been doing this since 2020, and now they react over here. The Fed is very reactionary, and the problem is, when they're reactionary, a lot of times you put on the gas and you put on the brakes, and a lot of times you end up going too fast, you get a speeding ticket, and then you throw on the brakes and you cause the guy in back of you to rear end you because, why in the world are you putting on the brakes in the middle of the roadway? So it's literally a situation where now the Federal Reserve's doing this. Well, housing prices appear to have leveled off here. Now, these are quarterly numbers, but I'm going to show you some other numbers that kind of illustrate my point that with this kind of a raise, it's very, very similar to the kind of raise here where they began to push the price of housing downward. Now, it took a little while, but the problem is places like Arizona were almost a desert as far as housing goes because they suffered by far the most. Places on the coast that were going down in value, people flocked to the coast that had money and bought things up and kind of kept propping those prices up. But in the midsection of the country, wow, 2008 was a disaster. But we come to today, and what do we have? Well, interest rates are going up very quickly. Housing prices seeming to have leveled off. But let's go ahead and look at what some current data looks like. That's not quarterly. I need a little bit more granular data to see what's happening over the last couple of months. So let's go take a look. Remember I said for the very first time housing permits have started going down into the 2008 crisis? That was unheard of. I mean, housing, you continue to build more houses because there's always more people. There's immigration, there's births, there's new people growing up, there's people that just need to live somewhere. Well, here's what housing permits are doing. So building permits have been on the downward cycle ever since it looks like March of 2022 and continuing downward till now. They're, a good 15% lower than what they were in March of this year. So housing permits are continuing to go down. Less and less houses being built. And, the story as the housing prices were running up is that the reason for the run up was that there wasn't enough housing. Well, if there wasn't enough housing then, why would the permits continue to go down now? No, actually what happened in 2008 that people just aren't getting their heads around is that when houses become investments and you get these people here that want to flip houses, it creates an artificial amount of demand. It looks like there's too many buyers for too few houses. And that's one reason why the house prices continue up so fast. But the challenge here is that it's not real people living in those houses. It's investors that are holding the house for a short time, usually never living there, maybe doing a few renovations so they can push the price of the house up further and putting it back on the market so that they can turn it and make $20,000, $30,000, $40,000 in the 4 to 6 months that they actually own the property. You get enough people doing that, and it appears as though you've got way too many buyers for the number of houses, and thus the price keeps on going up and up. The real problem here is the money was too cheap. The money was easy to get, and investors just jump on that opportunity to go ahead and get that easy money to buy more houses. So here we see housing permits going down in the current month. If we go to Redfin, now Redfin is biased toward realtors. It is a realty type of company. It is hard for them to admit that the markets may be going down. And in fact, until a couple months ago, you didn't see this kind of data, but now you are beginning to see the data. The median sales price you see over here is beginning to float downward. Not huge, not dramatically yet. It's going down from about a period right here in May. And I need to scoot down here a little bit to see what that number is. So you see that May number at 430, and you see this October number at 397. So what you're seeing here is you're seeing the market from May to October beginning to head downward. Now, without the 3-month averaging in there, you can actually see the downward tilt. We're also seeing that the number of houses sold during this period of time is going downward. Now, you say, well, this cycle exists, all along. You can see it happening here. Well, part of the challenge with it is it's heading down faster. If we go look at this is October numbers here, okay? Let's go back to the last October number. Now, this October number is 437 for number of homes sold. If we go back to the previous October, you have to go clear back to there to see the previous October. So year over year, it's gone from 621 down to 437, almost gone down a third. number of homes sold during that time. Now, why are there less homes sold? Well, the mortgages are too high. There's less buyers. Less buyers. What happens to the price when there's less buyers? Remember, I just said investment people, when the mortgage money was easy to get, drove prices higher because there were more buyers in the market, more buyers than homes. Now there's less buyers. And we also see, if we look up here, number of homes sold, we can go down here and see the number of homes for sale and see what's happening here. Right now it's showing a 4.6% year-over-year increase, and we are in cycles. Here's October. We go back to October last year, is in the middle of 2021. A few less homes here, a few more homes here, so there's more homes for sale. But what does that mean? There's less homes sold, more homes for sale, meaning more inventory, less buyers. What happens to price? Because of the supply and demand curve thing, where they join is where you find people actually making a transaction. When there's more buyers, it propels the price upward, because they buy all the houses and there's less houses to buy, so they start competing for houses and drive that price higher. Well, here what you're seeing is there's less buyers, there's more sellers, and now sellers are having to get aggressive the opposite way to lower prices to attract buyers to actually get in their home. And in fact, the months of supply now is increasing dramatically. In other words, even though there's less houses for sale, the amount of sales is going down so rapidly that the months of inventory is going up even faster, which combines those two numbers. So you see the situation that's happening. Data is showing that there's more inventory, there's less buyers, prices have to go somewhere. What happened in 2008 is prices went down when that occurred. We had to wait for mortgages to get back priced reasonably. You had to get the market to be reset. The mortgage bankers weren't loaning. The mortgage banking basically shut down. Here, what you're seeing is a different situation. The Case-Shiller index, which is an index of major cities around the country, showing that it's starting to turn down. So we've got both Redfin and the St. Louis Federal Reserve data showing that the price of houses are beginning to tip over. What does that mean for you and I that want to buy a house? It means wait, be patient. Houses are going to become more affordable. For those of you that are currently in a house or bought a house when it was really screaming high, I'm so sorry. You're going to have to wait through that horrible period of time through 2008 where houses dipped down in price and you had to wait for the appreciation to come back to sell your house in order to have some viable appreciation in the house to be able to put money in your pocket for a down payment on your next one. But there's going to be many places in the country where there's going to be bargains out there ready to be had in the short term. So if you like what you saw, please hit that like button, get this video out to other people, and please subscribe so we can grow the channel and get this message out to even more people. We'll see you later.